There we go. That should be good audio. Please let me know if you can hear me clearly in the chat box, please. Okay, a number of questions in here already. Welcome. Yeah, just wanted to come on Sunday evening as usual and just answer some questions, have a few conversations, and see where we basically go. Hopefully, everyone's had a good week. How is everyone? Asif, evening. Welcome. Thank you so much for being here. Food Dweller, I'm well, mate. I'm really, really good. Kirsten, I'm good as well. Thank you so much for asking, guys. So, yeah, I just thought I'd pop on really quickly just to answer some questions, have a little bit of an interaction and stuff like that. So, any questions you might have on the markets or anything else, you can ask me anything you like. So, yeah, let's have a little ganders of what we've already got in here. I'm going to start from the top just to be fair. All right. So let's have a look. What are your thoughts on Forex trading? Is this one here from King. Forex is okay. I think you if you're going to look at it, you need to kind of understand what you're doing. And if you don't understand what you're doing, don't touch it. It is very, very high risk. And it's not just about buying signals, unfortunately. You do kind of need to understand the actual science, the techniques behind it, technical analysis, how the markets move, how you're going to protect your downside, all that kind of stuff. I don't touch it with a barge pole because I don't have the time and the day or time in the day to do it myself. And I just don't have an interest in it. But I do know plenty of people who do trade it. The reality is a lot of people lose money. When they look at trading, just period, be that Forex or stocks or anything, it's a full-time job. And if you're coming across people are telling you that, you can set 2 or 3 trades in a day and that's going to pay for your livelihood, I would be very, very skeptical about that. Yes, after years of practice and honing your skills, that's possible. But if you're just starting out, just understand it's going to be a long, hard road, just like anything. Going to take time for you to master, but if it's a skill that you want to acquire, then by all means acquire it, because it is important. It really, really is. Hope that helps, mate. If you have any follow-up questions, obviously just let me know on here. Okay, so this is a follow-up from King here. I'm planning to start putting money into stocks. I find low PE healthy companies and aren't exactly blue chip, and find dips in price. Which trading apps are best for starting off? So eToro is probably a good one. You can start off with eToro. You can start off trading 2-on-2 on opening accounts. You need one with trading capabilities. So eToro would be one for you to perhaps have a look at. I'll pop a link quickly in here for you. You could also have a look at Fineco Bank, because their interface is actually it gives you a lot more intel than the likes of eToro. It's for proper traders. It's a bit daunting to get your head around, but the live news and some of the features that they have in there are brilliant. They're really, really, really good. So Fineco Bank, eToro will be some good ones that you can actually go for as well. Let me just see if I can find you a link. One second. I might have to find it a bit later on because I cannot find where I put it on here. So yeah, those two. I'm just thinking you could probably use. Stake isn't really a trading platform per se. Yeah, you can buy stocks and stuff like. You can do research in there, but if you're looking to put things like stop losses and everything in there on your trades, you're not really going to be able to do that within stake. So you really want the ability to have those trading tools specifically. So yeah, let me just find you a link. 1 second. Let me just find this quickly. May I ask, actually, King, is there any particular reason why you're looking to go for trading first? Because you do realize that trading and investing are 2 different things, right? And this is something that people often get convoluted and confused. They use those terms interchangeably, but they are very, 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 very different. They're not the same thing at all. Trading is one thing, investing is another. If you're going to be looking at, investing is all about holding long term. Trading is about taking positions, closing your positions in the short term. That could be a day, it could be a week, it could be, a 3 months, 6 months, it could even be a year in some cases. But it's not the same thing as actually investing. It's not the same at all. So, are you aware that there's a clear distinction between the two? Because if you're a first timer just starting out, then there is a huge argument to be talking about and be looking at ETFs, index funds instead, because that will help you diversify your risk. And I spoke about this on last Sunday's live quite extensively. So just a follow-up question for you, I guess. Let me know. Okay, yeah. So you're day trading, mate. If you don't understand what you're doing, leave it alone. You can lose a lot of money if you don't know what you're doing. It's not something that I teach you on this channel, though. Foodjewel, what's the name of the company you worked for in Canary Wharf? Why did you stop working with them? It was a company called MetLife. They're a big and American company, huge company, but I essentially moved on to advise people, essentially. So I left there 2017. I qualified as a financial advisor back in 14, 15. So I had an opportunity to go off and actually advise high net worth people for that period of time. So that's what I decided to do after leaving them. It was a great place, though. It's hold fond memories of that place, because from a professional point of view, I was probably at my best. Those 5 years were really productive, really challenged me, worked really, really hard. Obviously did well in terms of earnings, but more than anything else, it's the lessons and the development that I went under whilst I was there that really was the reward and has given me, kind of like dividends for the effort that I put in. And I think in all endeavors, it's the journey that counts and the lessons that you learn along the way. I think, well, that's certainly how I feel. Having worked in Canary Wharf, it was a massive, massive ambition to get there, somehow got there. And then for 5 years to work my arse off from being just a telephone guy to being on the exec team, running my own team. It was a great 5 years. And, you learn a lot about yourself and the fact that actually hard work does go a long way. And there are ways that you can, navigate through corporate structures, if you will. All right, we've got clear audio here. Okay, let's have a look at this. What do you think about Fidelity Index funds? I may have an eye on Fidelity Index US funds. Fidelity are great. I think someone asked this last week as well. Fidelity are great. They're a company that will do a lot of research on their index funds. So, I mean, if you have a look at Fidelity, Vanguard, they will all have like similar index funds. But what you will find differently is the composition of those index funds will be different. So, for example, if you take like an S&P 500, for example, right, you may find that the top 10 or the way the portfolio is constructed in terms of its weighting towards individual companies is different. And in cases where you find that, Vanguard has more of a weighting in Tesla than Fidelity might, that decision to put more in Tesla and less in Amazon, for each of the companies is all research driven. So these companies will spend a lot of time doing research around where they're investing money, where they're putting client money, and essentially the composition of the funds. But Fidelity is one of the biggest out there. They're massive, they're huge. So you can trust that they'll be very, very well researched index funds, really, really well researched. No, I don't think so. I mean, look, I know that they're opening accounts in Europe, or that was the word anyway. But I doubt very much that. I mean, I don't know. I really don't know. I think they've got to the point where they've got scale at the moment. They don't really need any new customers. I mean, their growth numbers were just insane over the course of COVID. So I don't know, unfortunately, when they're going to be opening new accounts. It is what it is, though, because a business like that to go from the number of customers they had to what they ended up with. I mean, that's growth that you would hope to see in 5-6 years, and they got it within a year, 18 months. Like at some point you get to a point where you reach critical mass where you're just like, oh, we're not going to do any more, because then operational systems start to struggle in the background. The customer services start to struggle in the background. And I think that's what happened a lot of the time with Trading 212, because they had obviously the delays in executing orders. Their third-party broker couldn't keep up with the volume of stuff that they were being asked to execute. So it's great for a company to grow at the pace that they did, but the operational side of things then become really, really strange. And I think that's kind of what happened with Trading 212. So I would imagine they're taking their time right now to get systems in place and make sure that they're able to come back online without any of those issues and go for the next push in terms of growth. Andy, hi Pete. As a married couple, should we both have an ISA each or just a single ISA? We can't max out a single ISA, and I expect we never will. Shall I divide the money and start one for the wife? You should, if you can. If you can have one each, that does make sense. Purely because I can see what you're saying. Because if you're not maxing it out, then you're not going to use the full 40,000. It depends how your household finances are set up, mate. But I would always kind of, when I coach couples, always approach things like the ISAs as a you have one each, purely because what that does, it's not about using the allowance across two people. It's about the conversations that then grow off the back of that. You're going to talk about it a little bit more, and when you talk about things like your savings and what you're putting into the ISAs or investing into the ISAs, that then talks into other things like your goals and what that money is meant for, and it can generally lead to a better money conversation as a household. So if you can, have it as two single ISAs, one for you, one for her, if you can. That's what I typically say to people when I coach couples. But I get what your point. If you're not going to max it out, it may seem as though it's a waste of time. And you need an element of trust really between the two of you in terms of, it is going to be put in there and left for the purpose that you intend it for. So for your goal, and one person isn't going to, be siphoning off funds unnecessarily or outside of the parameters of your goal. What do I think of Virgin Galactic? It's the only space company on the market, a long-term play for sure, but seems like a massive disruptor. In the domestic space, maybe. I've got Virgin Galactic, to be fair. The shares are doing okay. In the domestic space, potentially, they're disruptors. But I just think if you look at, you can't ignore SpaceX in that conversation. I mean, realistically, where is the majority of the money going to be made in the space race? It's going to be made with satellites, so on and so forth. So SpaceX is miles and miles and miles beyond Virgin Galactic. But their market is a completely different market. They're going for a corporate side, aren't they? With the potential to obviously place a human colony on Mars, which is still years off. Virgin Galactic are looking at domestic flights potentially and the applications that come off the back of that for potentially travel. So it's two different markets. I think long-term play, definitely a long-term play. But even with the test launch that they had, about a month, maybe 2 months ago now, there were issues with that, and they were raked over the coal. And I think that they're actually being the FAA either banned or investigating them at the moment. The share price hasn't reacted too badly to that. To be fair, it's been okay. It's been stable, but I think they still have a long way to go before it becomes entirely viable. They're talking about, warning lights going off in the shuttle whilst, they're taking off and them being completely ignored. They wouldn't be able to do that in the commercial space. But long-term holder, definitely. There isn't anybody in that space right now on the commercial flight side that can hold a candle to them, unless Elon and SpaceX say, actually, we'll give this a stab. Then I would think, actually, hang on a second. Maybe they have a little bit of competition, but I think Elon's vision and what Elon's all about with SpaceX is very, very different to that. You can probably talk about Blue Origin as well, but I think Bezos has a bit of way to go before he can even. I don't even know what Blue Origin's actual task is. Is it on the commercial flight side of things? Because he did it pretty much in quick succession to Richard Branson and Virgin Galactic, or is he trying to do what Elon's doing with SpaceX? I don't really understand what the whole deal is there. And of course, you can't buy SpaceX stock at the moment because it's not available. They haven't IPO'd it. But yeah, good hold though. Do you think these commission-free trading platforms just hide fees and commissions in the spread though? Look, so this is the thing, right? I've made a video where I talked about the fact that this stuff actually is not free, and people just talk about, well, I'm not paying any money. Well, it might be free to you in monetary, so it doesn't cost you on a monthly basis, but it's costing you something. Let's put it that way. So the order flows, all that kind of stuff. There's a question of whether that's legal to do in the UK, but let's put it this way. Robinhood, one of the reasons why they couldn't operate here in the UK and because they were supposed to launch, I think it was earlier this year, and they were like, no, was because they will sell the order flow book to the big banks. So if you go back to, times of GME and AMC, where everybody's on Trading 212 and Robinhood and Free Trade, and they're buying a position against AMC and GME trying to hold, right? They're selling that data to the big investment banks. So the investment banks wake up in the morning and they're like, okay, we know how many people have actually bought in the opposite direction of where we are. And what they basically do is they take a hedge. So there is no such thing as a free service. These businesses are making money in a way. A lot of it is in the spreads. So with eToro, for example, the spreads are there. They're making money on the spreads. And this is where the beauty of it comes in. If you think about how many people are actually placing trades on eToro and Free Trade and Trading 212 on a daily basis. I did a video recently where I talked about the increase in the number of trades on a daily basis. And this is just in the retail space, not just in the investment space as a whole. It's increased from something in the hundreds of thousands to in the millions a day. If you think about those numbers of trade and the size of those trades and this money that can be made on spreads, these guys are making some serious cash. And then they might also be selling you information or the order flows to the big investment banks who are betting against some of the positions that you're taking, which is why if you're trading, King, you also need to be aware of that, because at the end of the day, anything you trade. So, for example, if you're looking at Forex specifically and you're taking a position against the pound, the big investment banks wake up every morning, or the professional Forex traders will wake up in the morning, the market makers will wake up in the morning, and they know exactly how much is bet against the pound being at a certain, or bet for a pound being at a certain rate. And because they have lots of money, they have the ability to influence the movement of that price. And particularly within the Forex space, the banks don't have to justify whatever they do to anybody because they are the market makers, which is why Forex is such a difficult place to be. It's slightly different with stocks because you could argue that that's market manipulation, but it's not completely and utterly unrealistic and a falsehood that they do this. They do because they're holding large positions. They know that if they sell X amount in stocks and the price is likely to move to X, then potentially it takes out a lot of people that have either shorted or long day position specifically. So these platforms will make money on spreads and other ways. The issue is beyond the spreads, some of them may not actually tell you how else they're actually making money. So yeah. All right, but is it worth DCA a smaller amount than I would normally do, or saving it for a correction, like putting it aside? Look, we don't know when Elliot. When is the correction going to happen? If you can tell me that, that's the answer to your question. And then if you do have the sports almanac, by the way, then by all means, do share information with us, because we could all be very, very rich, or at least you could be a billionaire. But if you could tell me when the market correction is going to be, that right there is your answer. What is an iShares ETF and the difference between iShares ETFs and other ETFs? There is no difference. iShares is basically BlackRock. So iShares is a BlackRock version of a Fidelity or a Vanguard ETF. That's the main difference. It's basically the person who packaged and built the ETF. There is no other fundamental difference to it aside from that. It's like having Coca-Cola, then having another brand of Coke. It's just got a different wrapper, but essentially it's the same thing, but maybe with different ingredients. So like I was talking about before, different allocations within it. But iShares is essentially BlackRock, and BlackRock is one of the largest, if not the largest, fund manager in the world. So again, very, very well researched. They know exactly what they're doing. So looking to reinvest dividends. Just feel that the blue chip stocks are overpriced at the moment. So I'll try to make a bit more risky by going for slightly smaller companies. Yeah, I mean, the mid cap is doing really, really well at the moment. And maybe the small cap is also doing well. There's no denying that. Although I think over the last maybe week or so, they've taken a little bit of a hit. I mean, the reality is that just because you feel that a blue stock chip is overpriced doesn't necessarily mean that you shouldn't be using that within your portfolio if you're trying to build a diversified portfolio. You need to think about the reasons why a blue chip company would be in your portfolio. And remember, you're not buying it for the price right now. You're buying it for what you feel the stock is going to be worth in 3, 4, 5 years' time, essentially. That's what it all boils down to. The price currently means nothing. What do you think it's going to be worth in the future? And do you think that the share price is going to hold up for that future projection? i.e., are they making enough money? Are they paying their dividends? Are they breaking new strides into a market or introducing something new that will move the share price forward over your investment term? That's the real question. So your blue chips are there for diversification. Those are the strong companies. If you're going all in small cap, mid cap, then you're going to have huge volatility. And unfortunately, small cap and mid cap companies are going to be more susceptible to economic factors or political factors, or geopolitical factors. Essentially, they're going to be more susceptible to those. Whereas blue chips, yeah, they're going to be susceptible, but not to the same extent that small cap and mid caps will be. So I think for you, it's all about making sure that if you're trying to build a portfolio, that you think about actually making sure that it's diverse. You need a diverse portfolio. That's what it's all about at the end of the day. Yeah. Is it possible to have a Fidelity account in the UK? Yeah, you can. They do have a UK site. I know that they have an American site, but they do have a UK site, very, very similar to Vanguard. Hey, Carly, how's it going? How's it going, Carly? All right, let's have a look at this one. Do you still think trading 212 is worth using after the latest terms and conditions when they finally accept new customers? Yes. I mean, see, the thing that I didn't like is I didn't like the looseness of the language that they used in the clauses, essentially. If you look at the comparison when you look at free trade, which I did in that video, their language is a bit more reassuring. Whereas with trading 212, it was kind of like, this might happen. There wasn't that, right, this is what we're going to do to try and protect. They did do it, but they didn't do it as strongly as I thought they would. Whether it's worthwhile using, I mean, I've got an account with them. I've only got a small amount of money with them, though. So I've got a very, very small part of my overall portfolio with them. So do I move it? Do I go through the hassle of having to sell down everything and transfer it over? I can't be bothered. Whether you should use it or not is really a question of, are you happy with those terms and conditions? Most providers have similar, but the language in the terms and conditions around the assurances that they're trying to give you are really important. And I just think they were a bit woolly with the language. They could have been a bit more reassuring. That's at least what I think anyway. Is it possible to get a buy-to-let mortgage with no mortgage experience and not earning 25k salary? It's not a stupid question, mate, but no, you need a 25k salary. You need that. If you haven't got a 25k salary, no mortgage lender is going to look at you. That is a minimum income requirement that you need. You don't need experience, but you do need that 25k, and obviously you need the appropriate deposit levels as well. So don't forget that. But yeah, it's not a stupid question, mate. There's no such thing as a stupid question. Don't forget, let's have a look and see, where are we right now? Let me just go on to my live feed here. We have got 64 people in here at the moment. I just want to see how many likes have we actually got. You can really help me out with this, guys. Where are we? Where are we? Where are we? Here we go. Let's click on that. All right, we've got 24 at the moment. Let's get up to 30 if we can, please. Okay, right. Let's move on. All right, Carly, let's have a look at this. Point and sticking 20K in a ISA to benefit from tax-free versus actually investing that 20K and growing it. ISA pay not. It depends where you're putting it. If it's in a cash ISA, then obviously you're not going to get anything. But if you're investing it in a stocks and shares ISA, whatever you return you're getting on the stock market, you should get on your ISA account, essentially, Carly. And obviously the benefit of having the ISA is the return won't be taxable in any way, shape, or form. But yeah, if you've got money in a cash ISA, you're getting absolutely nothing right now. So, but obviously emergency funds considered, all that kind of good stuff. Yeah, invest in stocks and shares ISA will get you a better return over the long term. What are your thoughts on NFTs after the first bull run? NFTs, I mean, I think there's a market for it. I'm still kind of getting my head around how all of the NFTs work. I did a video on NFTs. I think with NFTs, you have to be able to identify the projects that are likely to do well and getting into them early, because I think they're very much a new kind of like asset class almost, and there is a market for them, but it's just identifying the ones that have legs more than anything else. It's very, very interesting though, but I'm still trying to get my head around it. Would 4 years be too short to invest the money saved for a deposit? Is it better in a bank account? I only invest a small amount monthly, but sometimes feel the rest is doing nothing. Okay, so this is where we'll get on to things like, hang on a second. I'm just looking at this feed and I don't like the resolution that we're working with here. Bear me 1 second. Let me just see if I can switch this up. That might be a little bit sharper. But what it does do, it constricts the view like this. But let's have a look at that. So as I was saying, right. So I think it's really important to be clear on what the goal is first. And what I'm about to say will almost be counterintuitive. And I appreciate the struggles that come along with trying to save for a deposit for a house. But when you look at investment timelines and how risk versus reward works from an investment theory point of view, really, you need to be investing for 5 years at least minimum. So 4 years is shy of that. And the reason for that is if you are, and funny enough, I speak about this on the podcast in the morning because I'm going through a bit of a survey. Explain that bit later on. If you look at the market crash in 2007, 2008, it took about 5 years to recover. So you want to buy a house in 4 years' time. If the market did crash, and this is a big if the market did crash, you could find yourself stuck in a market cycle where the markets might not recover for another 5 years. And then what tends to happen, you're either going to cash in your investment at a loss, hopefully not at a large loss, but at a loss. And that could then impact when you're going to get your property. And if you have to wait, you then have to also deal with the possibility that property prices also increase. So if you are investing for 4 years, I would say that it is too short of a term. Your risk is going to be way too high. And this is my view. Because you have things like the lifetime ISAs, remember that you're going to get £1,000 free from the government for every £4,000 that you put in, right? So that's a 25% return. That is a return. you shouldn't let investment returns and the appeal and the sexiness of investing in the stock market deter you or distract you from the goal at hand. The goal is the house, it's not the investment returns. And this is why I'm going to go back to the point that I made earlier, in the fact that what I'm going to say is going to sound like contradictory. I know that every little bit that you can get will help, because it's hard to save for a deposit. I know that. But you're going to get a 25% return from the government. So if you can, put it into a lifetime ISA, into a cash for 4 years, the investment risk is too high. But on the other side, on the flip side, over the next 4 years, the markets might blow up and do another 40%. But that's the risk that you are going to have to take. And I guess the big thing for you is you need to decide whether you're happy with potentially taking that risk, market correction within those 4 years, you exit with a loss, and you need to think about how you would feel if that were to happen and how much of an impact it would have on you buying the house. If you think it's not going to have an impact at all, and there might be other funds that you can access elsewhere, then you might want to take the dive. But that's just my view based on the way I think and the way I see the markets and everything. So yeah, I hope that helps. Would your coaching or advice be helpful for someone not knowing what to do with tax credits and having a lump sum of money and what to do with it? Asking on behalf of a friend. So the coaching service is tailored. A lot of the coaching that I do is mainly around just maybe financial goals predominantly and investing predominantly. If you're looking at tax credits specifically and you have a lump sum to invest, I mean, your friend, if they have a lump sum to invest, the big issue that they're going to have is making sure that that lump sum doesn't impact their tax credits. I cannot help with that, because that would almost be tax avoidance, and that's illegal, essentially. So you have a certain limit that you can have as a lump sum without it impacting any tax credits. I think it's $5,000. I think. I'll have to double check it, but yeah, I can't advise on, because at the end of the day, if local authorities find out that you have that money invested, your friend's going to get fined and potentially get into trouble and be asked to pay back tax credits over a period of time. I have seen it happen on occasion, but yeah, I mean, the coaching service that I do won't really help with that. If it's for the purpose of, I need to squirrel this money away so it doesn't affect my tax credits, I can't really help with that. If it's about investing and setting financial goals and understanding what to do on the investing journey, then yeah, I can definitely help with that. Is property crowdfunding worth a punt P, as some offer an ISA with 8% returns? Yeah, I mean, it could be, but obviously if they're offering an 8% return, then you should understand that it's high risk. There's a reason why they're offering an 8% return. And you also need to be very, very clear on the terms of the crowdfunding. Most crowdfunding investment opportunities are opportunities where you can't just, you need your money, you can't get it out, the money is gone, So you need to be aware of that. What are your junctures of being able to access your capital? What is that all about? You need to understand those terms. But if they're offering 8%, you need to understand that it's going to be high risk, because nobody's giving away 8% for free. For those who aim to select index funds and leave them to grow, why does it seem most people are prioritizing ETF advice and not non-ETFs? We don't have the 3K minimum in the UK, so am I missing something? Can you just clarify what you mean there? So when you say, so the reason why people will choose ETFs is typically ETFs are better priced than an index fund, and they give you more fluidity, more flexibility within the investment proposition. As far as I'm aware, there is no minimum $3,000 unless can you just elaborate on that for me? If you use Vanguard, the minimum is 500 quid or something like that. There might be a provider that you're looking at that has ETFs that has a minimum of 3 grand, but not all providers have a minimum of 3 grand, essentially. So yeah, maybe just elaborate for me a little bit on that, please. You trying to tell me banks can't be trusted? Oh my god. You know what? Dear. I mean, look, banks are banks at the end of the day. Banks are out for profit, which most businesses are. They are, but they don't have the best track record. And unfortunately, that is still true today, especially when you start looking at the old traditional banks. I think some of the newer banks, the Starlings, the Monzos, the Revolut, those kind of banks, and Tide, they're new, they're fresh, they're using tech, they haven't got the same structural, operational costs and pressures, essentially. So you could probably trust them a little bit more than the traditional banks. Let's put it this way: I've been in the industry for 16 years, and I do not bank with a traditional bank. I just don't. I don't trust them. I worked for RBS. They didn't tell me what a pension was, even though I was staff. They didn't tell me how important my defined benefit pension that was on offer at the time could be to my future. These guys, it's a business decision when they do things like that, and unfortunately, how can you trust an institution with your money like that when they're making those decisions purely from a business point of view and not for, even for the betterment of their staff? If they don't care about their staff, how the hell are they going to care about their customers? Unfortunately, that is the truth. So I don't necessarily trust some of the big banks personally. The newer ones are okay, but some of the existing ones, no, it's not really, not the traditional ones, unfortunately. I've got a 0% interest overdraft as a student. Will using it affect my credit score? No, it won't. The main thing that you don't want to do is you don't want to be going over the overdraft limit. So just try and make sure you can't keep within the corridor. If it's 200 quid, don't have, money going out of your account where, potentially you get to 250 quid overdrawn when your limit is 200. Then you're going to incur charges, all that kind of stuff. So you don't want to do that. But using it won't affect it. Try not to be in your overdraft consistently, though. Overdrafts are a funny thing. They're there as an emergency, but they're very, very hard to get out of. Notoriously hard to get out of, in fact. And I spent years and years and years in an overdraft, and it's just demoralizing. So I would say, if you can get away with not using it, don't use it at all. Really, if you can. And that's all about money management. And maybe asking for help from parents or family if you can. Use it as a very, 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 very last resort, and have a plan to pay it back. Kev, how you doing? I can see you. No, I haven't done that one just yet, Kirsten. I'm still looking at it, to be honest. I looked at it earlier today, and yeah, it's still not looking good. And I just need again, I've got a small amount of money in there. So I'm like, do I just leave it or not? But I've not done the video just yet. I've got quite a bit of content ideas at the moment. And I'm actually looking to pivot some of the content as well. So we're going through a planning strategy for that right now. But it just means that I've got to think about videographers and audio guys, and I actually need a team. And I want to do it, but it's going to end up costing me a ton of money to produce. And at this point in time, I'm trying to figure out whether I'd actually get a return on it. So, but it's something I want to do for the channel. So I don't know. I'm very much in a place of limbo at the moment in terms of, do I continue down the track of the content that I'm doing at the moment, or do I pivot? Because the stuff I want to pivot to is going to give me a little bit more enjoyment, but it's going to cost me money to produce. And for the series that I'm looking at the moment, is going to cost me in the region of about 3, maybe 5 grand to produce. And unfortunately, I just don't know where the payback on that is going to be just yet. But I don't know. I'm looking at a videographer at the minute, who's also an editor. He's actually helped me with my short film. So hopefully we'll have a bit more news about that. But it's audio, it's studios, it's actually organizing people as well, because it will involve people in the general public. So and this actually would be a good point to actually ask if you do want to be on the channel answering. So the idea is we're going to put a scenario and a topic in a room of people and ask you to discuss it and share your opinions on it. And there'll be some educational pieces within that. So if you're either here now as one of the 76 people who are watching this, or you're watching this in later viewing, if you are outspoken, you don't mind being on camera, and you would want to participate and be on the channel, then ping me a message on IG. I need to get my website page live. That's being built right now for people to register interest. But if that's something that you're interested in, then yeah, please let me know. But that video will come in about a week, maybe 2 or so. Any tips on swing trading? No, because I do not swing trade. Casey, do you think that the S&P 500 fund on its own and then smaller satellite investments in the form of individual stocks will diversify enough, in your opinion? No, because the S&P 500 is the US stock market, and the US stock market alone. You haven't got global exposure in there. I mean, there is no right or wrong answer to this, and there's no right or wrong answer to an approach, but it's all about what approach you want to take. But in my opinion is the S&P 500 it has location risk, and it's got quite a lot of concentration risk when it comes to the location, because it's all the American it's literally an American fund. So if anything happens to the American economy or anything like that, potentially you see the S&P 500 be hurt. Then in your individual stocks, how are you going to diversify? Which means that you probably have to allocate more money to diversify the individual stocks globally, which means research and really understanding how you research individual stocks, tracking, monitoring, reviewing, using your asset allocation parameters, having an asset allocation parameter, understanding when to move, when not to move, when you're going to literally look at rebalancing your portfolio on an individual stocks level. There's a lot of work that goes in behind it. And, I look around YouTube and I look around YouTube, and there's so many people that are producing active investment, content, but they don't talk about those kind of things, which are all very, very important. Even if you're holding for the long term and you have individual stocks, you still need to think about how often you're going to rebalance. At what point in your portfolio construction, if you're overweight in one sector or in one company, when do you put it back to get you back within your parameter? These are all really, really important stuff that a lot of active investment YouTubers either don't know because they don't work in the industry, and that's the unfortunate truth. So they've never been around, investment managers or sat in investment management committees or anything like that. They've just learned on their own, and they're producing content telling people what to do. And I think it's a little dangerous. So what I'm trying to say here is, in my opinion, it wouldn't be diversified enough, because you're going to have huge location, geographical concentration risk, because the S&P 500 is the American stock market. You would have to do a lot of work on the individual stock side to diversify adequately. And that will come down to, number one, technical know-how, actually having a plan, knowing what your parameters are, rebalancing. And more importantly, it's also going to be about the volume of cash or capital that you have to inject in. If you're playing with, 2-3 grand, arguably, you're not going to be able to have enough individual stocks of any tangible value to make it worth your while. So, yeah, maybe not what you want to hear, but those are my thoughts. For pension B, I'm a US citizen. Cannot sign up to the website to contribute to a pension. Yes, because there are regulatory rules around providers providing investment or pension products to US citizens. There's a certain amount of reporting that they need to do. It's quite in depth, and some companies are just like, we can't be bothered with this. So there are companies that you can use. I had someone actually ask me back end of last year, and I had to go through my contacts in the industry to find out whether and I can't remember the name of the person now that I actually spoke to, who said that, yes, we will deal with US citizens. But because it took me 3-4 weeks or so, she posted a comment having a go at me. So basically she didn't get the help. But there are providers that will help you as a US citizen, because they will submit to the reporting that needs to happen to the IRS. But they're very, very few and far between. If you message me on IG, I'll see if I can put you in touch with somebody on that front. But yeah, it's tricky if you're a US citizen. Hey Pete, do you think it's a good idea or too risky if someone invests their house deposit in a bond fund for the short term? Thanks. Bond funds can still go up and down. So, I mean, if you're looking at, fixed rate bonds, then yeah, I mean, fixed rate bonds are fine, because, with a fixed rate bond, you can get 1 year, 2 year, 3 year, 4 year, and you know that the coupon or the rate of return on that is going to be 1.2 or 3 or whatever percent it is. It's not going to be huge amount. It's not going to be 5%. But over the short term, just to give you that little bit extra, that's a better place to go. But if you're looking at bond funds on Fidelity or Vanguard or somewhere like that, you need to be aware that those funds will also go down, because they are funds after all. So the values will fluctuate based on what's in there and based on what Fidelity might or might not be doing, or Vanguard might or might not be doing in the background. So you still might see a little bit of movement, but not as much as in equities, obviously. Seb, when paying regularly into something like Vanguard Life Strategy account or the likes, does the day of the month for investment and subsequent trades make a difference? Does the day of the month for investment and subsequent trades make a difference? I'm trying to figure out what exactly you mean there. I mean, look, if you're paying money in, let's just say you have a standing order or direct debit going on the 25th. The money will be received by Vanguard. Then they have to allocate the money to your account. Then they have to invest it into your choice. So Life Strategy Fund 100, whatever. That will take maybe 5 days for them to be able to do that. So it's all complete. So you're going to have a gap, essentially. So yeah, your money's not going to be invested on day one, the day you transfer. And if there's any market movements in between that 5 days where your money is received and then invested, then yeah, it will have an impact, because you're not getting that immediate investment impact. But that swings and roundabouts, mate. Sometimes the markets will be up and you wish that you invested earlier. Some days the market will be down where you're like, oh, thank God I wasn't invested early. You pick up the shares or the investment at a discount rate. So it can make a difference, but I wouldn't focus on that as an investor. The important thing is that you've got something set up for you to be investing. Well, at what point you get invested is just, it's neither here or there. Hey Pete, Coinbase have placed my account under review 2 months now. Customer support appalling, keep closing tickets, no email or contact. I have over 20K in funds. What? Okay, so what is it under review for? Like, if you go into Coinbase, is it ID or what is it exactly? Like, if you've been trying to speak to them, I know that's frustrating, mate, but they will have a reason why it's under review. So it may be ID related or account setup related. You need to find out really the reason why it's under review. If you need to resort to Twitter, because a lot of these companies, they're very, very responsive on Twitter, because Twitter is public domain. So if someone's screaming, you've locked up over 20K of my funds and you're not getting back to me, people are going to be seeing that on Twitter and they don't want that. So maybe try Twitter, maybe Kev. But yeah, it will be under review for a reason. You need to find out why so you can get it fixed. What's the main app you use to buy individual stocks? I use a number of them, mate. A lot of the apps that I review, I use. So, I mean, at the moment, how many have I got in here? I have literally got about, in a folder on my phone, I have got in that one probably about, that's 2 pages worth. So in here, I've got eToro, I've got Trading 212, I've got Free Trade, I've got Hargreaves, I've got Stake, I've got Money Farm, I have also got Bitpanda, I have got Invest Engine, I've got Orca, I've got quite a few. But the main ones that I use are eToro, I use Trading 212. I've been using eToro more and more and more now because obviously you can have cryptos in there as well. So I've got a bit of crypto in there, but I think I will continue to use Bitpanda because I do like the interface and I like the whole crypto index, the ability to buy, the top 10, 15 or 5 cryptocurrencies. They can't market to the UK marketplace right now, to UK retail investors right now. But I did test this out, and actually you can buy stocks and you can buy those crypto indexes in Bitpanda. So I'm probably going to use them a little bit more purely because they have that functionality, and you can buy metals, gold, silver, palladium, platinum in there as well. So yeah, those, if I had to give you maybe my top one is definitely eToro. I use that a lot. I'll probably use Bitpanda a little bit more. And I don't really use free trade if I'm completely honest. So those are probably the two, but I use eToro a lot. Cheers for that, Kev. If you haven't liked the video already, please do. That would be amazing. Thank you. Do you still rate the Vanguard Life Strategy funds? Yes, because they're there to do a specific job, which is to give you diversification to equities and bonds under one wrapper without you having to do it unless you go 100%. And really, to be honest, for most first-time investors, again, I talk about this all the time, and it's boring, but I really don't care. People really, really, really need to understand risk and risk theory when it comes to investing. Like the life strategy funds are there built, they are risk weighted portfolios. So they are there to match specific risk profiles. If you're investing and you have no idea what your risk profile is, you want to hide into nothing. And many people will think, oh, I'm an adventurous investor. 99% of people are balanced. I've coached probably 70 to 80 people this year, and I've come across maybe 5 people who are adventurous out of the 70. A large proportion of them, I would say maybe 60% of them, thought they were adventurous, but actually they're balanced when we go through a questionnaire, when we go through a real risk questionnaire. That's the stuff that I do in coaching. So they're there as risk-weighted portfolios. And the reason why that's important is because you don't want to get invested into something. And the video on Tuesday, I'm going to talk a lot about this because there's been a research or survey that was done recently. And the numbers are very encouraging, but there are some of those the data points in that survey that for me are frightening, like really, really, really worrying. And the risk profile is really, really important. So, if you're using Vanguard, they're a great place to start. They're a really, really good place to start. Carly, so like you can stick 20K into a stocks and shares ISA and all profit is yours. So when you say you shout, make sure your allowance, this is what you mean. Yes, basically. So, within your ISAs, you've got cash ISAs, stocks and shares ISAs. So your stocks and shares ISAs are invested in the stock market, your ETFs, your individual stocks, all that kind of stuff, whatever tickles you fancy. Then you've got your cash ISAs, which is just cash in a bank account. Those will be getting very, very low returns. But the stocks and shares one over here, where it's invested, you could do 10%, 15% per year, and the money doubles. All of it is going to be completely tax-free, which is why the first rule of financial planning is tax sufficiency first. Use your ISAs, max out your ISAs. Right, this is a good one. With inheriting a pension, is there a way to avoid reduced inheritance tax to be paid? When inheriting a pension, and if so, can required changes be made later on? Pensions are outside of the settlers or the person. Right, let me just phrase this right so it comes across properly. Pensions are outside of an estate for inheritance tax purposes. So if you're inheriting a pension, it is outside of the person's estate that is passing it to you. Therefore, you don't have any inheritance tax due. You don't have to do anything at all. It should be recognized as being outside of the estate for inheritance tax purposes. So really, you don't have to do anything at all. Do you think stocks and shares lifetime ISAs are worth it? Yes, if you're if your plan to buy in this house, or your roadmap to buy in this house is, 5 years plus, because at the end of the day, you want to have that time so you can manage your risk and then potentially get that return over the 5 year period. Um, but like I said at the top of this, with a lifetime ISA, you're already getting a 25% return from the government. So, and you're doing that every single year, pretty much. So, over 5 years, that's what, 20 grand, with another 5 grand on top. So that's 25 grand that you're going to get, 5 grand from the government, 20 grand from you for each of the 5 years with the £4,000 allowance. So it is worth it, but you just need to weigh up that risk factor, because again, you don't want to be chasing investment returns and lose sight of the fact that the real goal here is to purchase a house. It's not to get stock market returns. The goal is the house. You're going to get a return from the government for using a lifetime ISA. You need to sit down and think, okay, are you happy to take that risk? If you are, then go for it. But if you're going to be a little bit, I don't like the idea of investing this because I need it for a house, it might go down and, I might get stuck, then, you think twice about it. Are you in the squeeze? I don't know what that is, mate. Do you think stocks and shares ISAs are worth it with regards to saving in addition to pensions, or is it best to simply put money into your pension? This is a really good question. And there's a long answer to this. Okay, so ISAs are tax efficient vehicles, right? So you can grow your ISA completely tax free. The added benefit you get from that is, if over a 10-year period you put £20,000 in every single year, your contribution over that 10 years into your ISAs is 20 times 10, so that's 200,000. Then if you're getting returns on top of that, and let's just say you've got 300,000 over 10 years into your ISA, any income you generate from said ISA is also going to be tax free. So that's a big advantage of an ISA over a pension. And obviously with an ISA, you can access the ISA whenever you want. Whereas with a pension, under current legislation, you can't access until you're age 55. But with that being said, a pension will basically attract contributions, so money being paid in from your employer. So oftentimes when I work with people on coaching, I often ask them whether they are maxing out their contributions in the workplace scheme, because it makes sense to do so. Because if you're putting in, let's just say, 8%, and your employer is willing to go from there 3% to 8%, then you're attracting free money. So it makes sense to take that free money and not contribute any extra money that you would have put into that workplace pension into an ISA. So it swings around about. It really depends on your circumstances. I think you need to have a look at your pensions and your ISAs in conjunction with what your goals are generally in life. So for example, if you know that you might need access to the cash at some point in the not too distant future, then an ISA potentially is the right place for you to go. But then the question still remains is, can you still leverage and get more free money from your employer, and maybe do a combination of the two things? So maybe not a direct answer as to which one is best, but there is no direct answer, given the fact that I don't know anything about you, Janina. I don't know what your circumstances are. If I had a bit more of an idea around your circumstances, then I'd be able to say, right, these are the main factors for you that you need to consider, and these are the options that you essentially have. Again, that's the kind of stuff that I would do, kind of like in coaching and stuff. But you need to look at them both hand in hand, pros and cons, but in context to what your goals are generally life-wise. And you followed up here on a SIP. I mean, you definitely shouldn't be paying into a SIP if you can get more money from your employer, for sure. If you run your own business, that's a completely different conversation as well. So do you agree that REITs are more superior to buying properties on mortgage? No, I do not, because with a REIT, you don't actually own the asset. With a mortgage, you do. There are advantages and disadvantages to that. REITs can be used if you don't have a deposit for a mortgage. So you can invest in commercial properties and a whole range of properties via that REIT, but you don't have any ownership. Whereas if you're buying a property with a mortgage, the asset is yours. The capital appreciation that comes with that mortgage or that purchase of that property is yours. It's your asset. So then I don't agree that they're more superior, not in the slightest. So this one. Question for you, please. Is it better to go to uni, like academic way, or the university of life, practical life experience, like what you have more or less completed? This is a really good question. You know what? If I could do it all again, I probably would go to uni. Only because for me, I feel that I would be further down the line if I had gone to uni. I would have done really well in uni. I always did well in school. Um, but just knowing that in certain circles, as wrong as this may be, particularly when you look at Canary Wharf and the city in that way, they do value the university degree. And the messed up thing is, you know, you don't even need to have a relevant degree. But as long as you have graduated with a degree on your CV, I think it's perceived that you can show perseverance, that you can stick to something. And I think that's utter BS, because what does a piece of paper tell you about someone's character? It tells you absolutely nothing. There were tons of guys, and one guy in particular that I used to work with in Canary Wharf, who basically, he was really, really posh. And to be honest, he could walk down the street with his shoelaces completely untied, tripping over himself, and he wouldn't know what to do. You know, that's just the reality of things. If I could do it again, I probably would have gone to university just to give me that foot forward, if that makes any sense. But then again, there's nothing wrong with, you know, what I've done. I'm quite pleased with what I've done and how the things that I've learned along my journey. Like I said, it's not necessarily about what you earn and how much I earned there and how well I did. It was the personal development and the sense of self-belief that you get when you go through certain things and you go through challenges and you really push yourself against the odds to achieve something. That right there is really where the reward is. It's not financial, it's that personal character, personal development that you get. So I wouldn't, if I could do it again, I would go to university, but knowing that I could never do it again, I don't regret that I didn't, if that makes any sense. Cheers for this, Abby. Thank you. I really do appreciate it. Right, there's a conversation going on there with Food Dweller and JR Blue. What would you advise anyone's first big investment be a property? As long as you know what you're doing, like property can be made out to be really sexy and stuff, and that's all very well and good, but there's also work to be done when it comes to property as well. You need to understand what you're doing. You know, what are you, especially if you're going into rentals and stuff, what are your yields, location, you know, making sure that you're picking the right property, making sure you're getting, you know, a fair valuation and you're buying it at the right price. There's a lot of stuff to learn, mate. There's nothing wrong with having that as your first property. Just do your homework is the most important thing. Okay, ETFs over index funds. The reason they give a 3K minimum, which only applies in the US, I was wondering if there were more pros to ETFs besides flexibility. Flexibility and cost are the main things, mate, when it comes to the benefits of an ETF over an index fund. You'll find that a lot of the ETFs will mirror index funds as well, to be honest. So flexibility and cost is often one of the big reasons why people will favor ETFs over index funds. Question about bonds. Is it better to get global fund or just UK gilt funds to invest in. That really depends on your investment strategy. I mean, global is always good, so you can have a mixture of territories. And there are also, you need to understand the difference between corporate bonds and government bonds, because the global bond fund will have corporate and government bonds in there, whereas you're talking about comparing that, which is corporate and government, with UK government bonds. So fundamentally, again, what is your goal? How long are you looking to invest for? How does the selection of these actually tie within your goal, and what role does it play within your portfolio? Because you can't really compare a global bond fund that will have corporate and government bonds or debt in it versus UK debt alone. So it's going to be about making sure it's going to be about making sure that it's the right fit for your portfolio. It's a good question. What would be your advice for a mature person in the late 50s starting out investing? Really good question. Please, please, please don't be sold the dream, and just be careful that you are coming across reliable information. There are a segment of people who will target older people purely because, for most older people, and I know this from advising, there is this sentiment of, I'm starting late, so I've got to make up ground. And with that, some people want to take more risk than they are able and should be taken, if that makes any sense. And because they know this, what they'll do is they'll promise all kinds of like great returns and all of this stuff, when really it's just complete and utter nonsense. So, if you're in your late 50s, it's never too late, but just try and make sure that you're taking a really measured, thoughtful, prudent approach. It's really, really, really important for you to be clear on what your goals are. You're going to be closer to retirement than most people. So the first thing I would be doing with you, if you were my client, would be to be going through pretty much your entire financial landscape, like everything. Past pensions, past places that you've worked at, because there will be pensions there if you've worked in a company before. I'd want to get a good idea of your entire landscape, and then start talking about what your goals moving forward are. Start to map out your timeline, and then start to look at the options that meet your circumstances. That would be what I would be doing with you if you were my client. It's not about plucking something that you see or hear about online necessarily and thinking that's going to suit you. No, you have to make sure that whatever it is that you go into suits what your objectives are. I talk about goals all the time. This is why I talk about goals. Your goals will inform what you invest in and how you invest in and how long you invest in for, your risk profile, what level of risk you're able and willing to take, all of this, that shebang. So just be careful of the information that you're finding, and just be very measured and very, very thoughtful. Just going through, there is a conversation here. Yeah, there's a good conversation there on property. Yeah, our IRAs and Roth IRAs are American. I've got pension. Our version is a pension. I do have a pension. Okay, this is a question. Bump It Panda, is there any charges on currency exchange from pounds to euros? No, not that I'm aware of. If you transfer money over, it lands into your account in pounds. So if you're buying in different currencies, I'm not sure. I don't know. I've not noticed it, but obviously they charge. If you're doing a debit card transfer, that's almost instantaneous. They charge you 1.5%. So I would assume any currency exchange fees are wrapped into that 1.5%. Someone mentioned hyperfund. It's not regulated though. What do you think about it? You know what? Some people have asked me about hyperfund before, and because I get so many requests to like review things, I could be reviewing things till the cows come home. Um, it is one that I've looked at just from a cursory search, and I wasn't particularly impressed at what I found. Uh, hyperfund. Okay, so I mean, it's in crypto basically. So if you don't understand how crypto works, stay away from it. Whatever you invest in, you need to have a cursory or at least a very high level understanding of how it actually works. Um, so this is in crypto. Hyperpay, hyperfin, hypermining. I can't give comment on it because I'm just looking at the website right now, just browsing it right now. But if they're in any way promising ridiculous returns, then I would be very, very skeptical of it, because oftentimes when you come across places that are offering large returns, you have to take a second look at it. I know that they also have a DeFi offering, which I'm very, very excited about DeFi and what that could actually do for the financial services landscape. But without looking at them properly, I can't really give a real good view on it, because it looks like they've got a lot going on with the DeFi, and they've got the hyper ecosystem and stuff. So can't really comment if I'm honest. But yeah, really, you kind of need to understand what they do and the instruments that they're using. So how does DeFi work? How does the blockchain work? You need to have a cursory understanding of all of that before sending your money to someone like that. Came across your YouTube videos recently, Pete. I'm 33, working full time. I've now committed to investing 3,000 yearly into Vanguard Life Strategy 100, and I have an employee pension. I'm planning on continuing to work. Look, this is amazing. This is brilliant. Yeah, look, carry on, mate. Look, at the end of the day, investing is very much the vehicle to create wealth and stuff like that. So if you're able to, invest those amounts of money and continue to build, that compounding effect will really make a big, big difference. So glad you're here as well, mate. There's a follow-up one in here. I'm just looking to have a decent pot of around £500,000 on my retirement. Are there any other investment opportunities that come to your mind that I should look into? Thanks for your great content. If you're not looking at crypto, you should be looking at crypto, mate. That's a really big opportunity right now. So definitely have a look at crypto, Bitcoin, Ethereum. Those are the two biggest ones out there. And obviously you got the likes of Cardano and things like that. I would definitely be looking at crypto and try and, also build yourself a side portfolio of crypto, because, it's a huge opportunity and it's a huge disruptor. On the whole £500,000 thing though, have you actually mapped that out? That'd be a question for you. So if you're investing £3,000 a year, do you know what rate of return you need to be getting in order for that to compound up to 500,000? I'd also be asking the question of how long are you towards your retirement, and what income do you need when you get to retirement as well, to actually answer the question whether £500,000 is enough. I hope that makes sense, but that's just a few things to think about, because by answering those questions and knowing the answers to those questions, you'll very quickly come to an understanding of whether what you're doing now is enough or whether you need to ratchet up as you earn more money moving forward. Yeah, man. What's going on? How are you? Welcome. Thanks for joining. I'm just looking at the time. 1 second. 1:17 we've been on here for now. Okay. There's quite a few on here. Right. So let me just try and get to a few more before we call it a night. Where was I? Was there? Okay, cool. Do you think investing into your pension in your 20s is smart? Yes, it is. Absolutely. Um, what's the best way of balance of what's the best way to balance adding to a lifetime ISA and adding to a stocks and shares ISA? Alternate years or focus on stocks and shares? Right. So the purpose of a lifetime ISA is either for house purchase or retirement. Okay. So within your lifetime ISA, it's $4,000 a year. That's your maximum. So if you're looking to buy a house, then it makes sense you put it into a stocks and shares lifetime ISA. If you're looking to buy a house and that timeline towards that is 5 years plus, really, really preferably. Then I'd be looking at stocks and shares ISAs if you're looking to invest for any other reason. But there's no reason why you can't alternate. You absolutely can alternate if you want to. There's nothing wrong with that at all. But I think your decision has to be goal driven. It has to be led by your goals, by what you actually want to do. These accounts are there for a reason, for a purpose. So does the purpose of the account match your goal? Because bonds are performing so badly, does that not hurt the Vanguard Life Strategy funds? Yes, it will, but you need to remember the role of a bond in an investment portfolio, essentially, is there to diversify your risk. Bonds performing badly, you have equities performing badly sometimes. So what's the difference? It makes no difference at all. You could have equities performing badly, bonds performing really, really well. Does that then hurt the life strategy funds? Yes, it does. Same thing. It makes no difference whatsoever. Marky, how you doing? Had a pint waiting for it. Sorry, mate. I was in London that day and I don't have your contact details either, mate. So if you're on Instagram, if you can ping me a message on Instagram with your number, then we can go on WhatsApp and stuff like that, because you are literally round the corner from me. You're not far from me at all. So, and it would be good to meet you because you're so close. But yeah, I was in London I think you said Thursday. I was in London on that Thursday, doing some I was in the editing suite for the short film that we've just shot. So yeah, but yeah, please do reach out on Instagram and ping me your number, mate. We can talk on there. Good question. Do you think Neo can do better in the future? I think it will. I mean, I have got a little bit of Neo. I've not looked at it at all, to be honest. What is actually doing? Neo. I mean, I'm up on Neo, but I'm not nowhere near as where I should be based on. I mean, the thing with Neo is they are a challenger to Tesla in the Chinese market. The Chinese are notoriously loyal to Chinese built brands. So the potential for them is huge. They do have some issues around the fact that they are subsidized and their manufacturing facility is subsidized by the government, and they have to cover any losses and pay that money back to the government. But ultimately, the big challenges there are battery technology. Yes, they've got the whole idea of replacing the batteries. How feasible really is that? Car sales is going to be really, really important for them. They do have challenges, but long term, if you're looking at this 10, 15 years into the future, will they be good? Yes, as long as they are around. And I don't see them disappearing purely because they have a lot of backing from the Chinese government right now. And they do have a big clean air initiative, which feeds very, very much into Neo and what they're doing and the product they've developed. Do you recommend putting a 6-month emergency fund in one place or split it between an account with easy access and an account which requires notice but has higher interest? Yes, you can do that. Absolutely. It's just figuring out what your splits would be. So I think the question will be really for you is, if you had to access some cash right now, what do you think would be an ample amount? Is it $1,000? Is it $2,000? Is it $5,000? Then, you decide from there where the split is going to be. But there's nothing wrong with doing that at all. Nothing wrong with that. What's the normal average rate on global ETFs? I don't know without looking at it, mate. There are lots of global ETFs as well. So you'd have to look at all of the ETFs and then extrapolate the data and do an average across all of them. So I don't know what the answer to that is right now. Yeah, overly inflated market right now. Yeah, I mean, but we can't do anything about that at this point in time. So this is, horse for courses, mate. You've got to roll with it. But I don't know what the average is without looking at all of the ETF details. Kevin Samuels. Oh my God. I have actually had, yeah, that was early in the year. It made me laugh, really, to be honest. I don't think I look like the guy. He would never come on wearing a hat like I am right now. He would be here in a suit or something like that. Maybe I need to try that out one day and just rock up here on a suit and stuff and see how that goes down. But I don't see the likeness, to be honest. Do you like the YouTuber versus money? I don't know of that. Is that an account? I've never heard of it. I'm guessing that's an account, right? Let me just have a look. One sec. I don't know. I can't. I've just done a really brief search. What is that? YouTuber versus money. Let me know. Oh, mate, this is a really big question. Family investment company versus a trust. Okay. How do I put this in a really simple manner? Okay, so typically you need to be at certain levels of wealth to be looking at these kind of options, especially a family investment company. So basically, if you have large assets, essentially, and you want a way of actually using those assets, so cash, to generate an income, but you also want to control how the income is distributed, how the tax on the income is actually then paid. You basically want to have control over a large sum of money that is either being inherited or has been earned as new money. You would use a family investment company essentially to buy assets which could be income generating, so on and so forth. And with a family investment company, you're also going to have additional benefits when it comes to things like inheritance tax, so on and so forth. So essentially a family investment company is essentially a company where you can house investments in, and from that you can generate income, you can control assets, you can put assets within the family investment company that is set up within a legal framework for you to do within the tax rules, but be able to exploit the tax loopholes that are available. Now with a trust is a legal document that basically has parameters set around it, around how a pot of money, either inherited or made, is then used to either generate an income or pass down to beneficiaries, essentially. So with a trust, you need solicitors to basically set this up for you. Within the trust, you can also have investments as well. So the two are a little bit similar, but they are used in very, very different user case scenarios. Normally, a family investment trust is used for very, very large amounts of money where there needs to be active management going on into it. You can buy shares, you can buy so much and put stuff into that, but you're not bound by a certain set of rules like you would be within a trust. So with a trust, you need solicitors, you might need an investment manager. A family investment company, though, is run by an investment manager or an investment professional, managing the investments, distributing income, dividends, managing the overall well-being of that family investment company for the purposes that it's intended for. Whereas with a trust, you have a settlor, you have beneficiaries, you have people who are there to look after a pot of money and invest it according to the rules of said trust. That's just a very, very brief kind of explanation, James. It's actually a very, very big topic of conversation. But yeah, that's just a brief kind of explanation. S&P 500 or US equity index fund. If I say one over the other, that doesn't mean go and buy it. I think they do two different things. The S&P 500 is the top 500 companies in the United States. With the US equity index fund, you're going to have more holdings in there. So you could argue that the latter is more diversified than the S&P 500, because within the US equity index, you're probably going to get some small cap and some mid caps too. So again, horses for courses. What do you prefer to hold? Do you want more in there? I think the US equity index fund has actually performed pretty well when you do the comparison between the two. All right. Okay. YouTuber talks money. YouTuber talks money. I still haven't got that count, mate. I don't know. Right, time. We're coming up to an hour, 30 minutes. So let me just see if there's another one in here that I can ask, that I can answer really, really quickly. This is a good one. I love the follow up to this. Dave Ramsey, and the follow up to that is this. Listen, he's been around for a very, very long time. I think for most people who like create content online, especially financial content, they would have paid attention to Dave Ramsey. I mean, I've watched Dave Ramsey. He's actually very, very good. I mean, he is a qualified CPA, which is their financial advisors out in the States. He takes a very practical approach to the answers that he gives when he does live shows, kind of like this. He's very, very direct, but he has some very old viewpoints, and he has a very kind of like harsh way of dealing with things. But then, if I watched one of his videos once where this couple were talking about the fact that they're in like $1 million worth of debt, and he's like, I'm going to destroy you for the next 5 years, so you can't breathe just to get out of this debt. And sometimes that is required. If something is really, really, really that bad that you need drastic action, he's the kind of guy who will tell you what's up. He will be like, listen, this is what you need to do. He is helpful. He is very, very good, but he does hold some very old kind of like thoughts and train of thoughts. He has a very old mindset, which is why this comment made me laugh. But yeah, he's got a very, very big show. Very, very big show. Very, very successful as well. Uh, 53. I don't have a good pension pot at present. What would you suggest? Well, the first thing is, and I kind of alluded to this a little bit earlier on, you're closer to retirement than most people. So what's your retirement date? If you don't have a good pension pot right now, what is good? I mean, what do you regard as good? Good for many people is subjective. So what is good? That means different things to different people. Also, you're 53. So it is possible, that you have old pensions from previous employers that have money in it. I've seen it before. I went to see someone when I was advising. She was 56, and she was like, I can't retire right now. I'm knackered, but I've got to work for another 4 or 5 years to, try and make sure I've got enough coming in so that I can, just live and so on and so forth. And I asked her, where have you worked previously? And she goes, I was only here for a short period of time. Then I was there for this amount of years, and I didn't really pay into any significant pensions, but we wrote away, came back, and there was 150K in those pensions, 4 pensions altogether. So, you may not think that you have a lot, but if you have worked at old places, or old employers previously, then you may have pension provisions that you're not aware of. If that is the case, I would really strongly suggest that you maybe I'm just trying to think how you would go about it. I mean, you can do it online. There are government links online where you could literally just type in your name, your national insurance number, and the name of your old employee, and it will tell you who the pension administrator was. You can contact them, give them the same information. They can tell you whether you have a pension pot with them, but that takes a little bit of work. I was going to suggest people like PensionBee to do that work for you, and they could. But if you have a defined benefit, which you might because you're 53, and if you've worked through the 70s and 80s, you might have a defined benefit, final salary, guaranteed pension somewhere. They won't be able to do that transfer for you. So the first thing you can do is, try and think of all the places that you've worked, come up with a list of them, and see if you can source the information on it. The second thing is think about being clear on when your desired retirement date is. Is it 60? Is it 65? Is it 58? What is that date? You will have state pension, which is a good help. But then it will just be about trying to think of how much money you're going to need in retirement, and then try to formulate some kind of plan. I can't give you specifics because I don't know anything about your situation, Jacinta. But yeah, this is the kind of stuff again that I do. I do this kind of stuff in coaching, but I need more information pretty much to be able to, give you concrete. Right, these are definite considerations. These are the kind of things that you need to be looking at, so on and so forth. Anna, how you doing? I've just seen that you popped on here. All right. Okay. Cool. Let me just answer this one. Pension B is great. Yeah, they're really, really good. I've got part of my old pensions with them. Easy on the phone. They've done really, really well. Performed really, really well. I can't really say anything bad about them. They're really, really good. So, all right, guys, appreciate you for being here. It is now an hour 33 minutes. We've got a good amount of likes on this. Thank you very much, guys. Appreciate it. Might do another one of these next Sunday. I pop these up really, like, depending on how the week has gone and how my Sunday's going, really determines how often I do these. I would like to schedule these, but the reality is there's a lot going on in the background, and I'm trying to get a bit more balance between everything else that I do and obviously YouTube content and stuff as well. So, and we're heading towards the end of the year. I mean, it's been an absolute whirlwind. It really, really has. And I am trying to really think about how I'm going to keep the channel sustainable, keep it interesting, and basically keep it entertaining for me as well. Because I don't want to keep going over the same old content. I don't want to do that. Next year is going to be the beginning of January is going to be, when did I start this? 2019 will be 2 years in January, which is a long time. And this is going to be circa, at that point, probably 250 videos or something like that. That's a lot. So I feel as though there's only so much content that you can produce on the investment side without sounding like a broken record. And I already feel like I sound like a broken record already. But yeah, I want to try and keep it interesting. So I'm trying to pivot and think about how I can actually pivot and make it interesting as well. But yeah, we will see how it goes. But as always, I appreciate you guys for being here on a Sunday evening. Have a good week, whatever it is that you do. Yeah, video Tuesday, Friday this week. And yeah, appreciate it. Catch you later on.